All right, well, let's talk about this and more here as we do kick off the final trading day of September. Friday's jobs report is expected to give more clarity on the Fed's path forward for rate cuts. For more, we want to bring in Dana Dioria, Envestnet Solutions Co-Chief Investment Officer and Group President. Dana, let's just start right there as we talk about some of these big tests that are ahead for the markets. We got the jobs printout on Friday. We've got earnings season kicking off very soon. What are you most closely watching?
I think it's got to be employment at this point. Obviously, inflation looks like it's been tamped down pretty well this cycle. Now, of course, that doesn't mean, it's gone for good. But I think the unemployment rate, the jobless claims numbers, the various numbers that the Fed gets to get a handle on how employment is going to be the single biggest factor. And then, of course, you have, how the economy is doing in general, GDP. Markets, of course, have done phenomenally well this year and continue to do so. So, I think, you can make an argument that we're not exactly looking at recessionary conditions. And if we are going to hit this soft landing, it's hard to imagine the Fed needs to cut as much as as the market might hope, especially since we already just did the 50.
Well, Dana, it's interesting because we did come into the month of September with some worries about the labor market, about a potential recession. Can we put all of those worries to bed? And how big of a concern is that for the bears out there?
One thing I'll say is, September is notoriously volatile. October is certainly volatile. We're very close to this election, very partisan election, as we all know, and a lot of uncertainty coming into the markets over that. Now, historically, that doesn't, bode poorly for markets necessarily on a long run return basis, but you can expect volatility. So I think, certainly the Fed's 50 basis points, as you note on the screen there, I think there's an element of that being a catch up from July. And I do think that we're on track probably for another 50 by the end of the year. But another 50 in November seems, a little questionable to me.
So then is the market maybe getting a bit too overexcited or a bit too aggressive then on what is already being priced in? And maybe what does that then tell us about some of that spike in volatility that we could see?
Yeah, well, the market's been overshooting on expectations of the Fed pretty substantially and, pretty regularly, right? So I think the 50 basis points was what the market had hoped for. They got it. The kind of chatter now that maybe we get another 50 in November, I think is maybe overshooting, but I thought we'd probably get 25 candidly in September and they went with the 50. So, I think the volatility in the market notwithstanding, the employment picture holds up. I wouldn't expect more than another 25 this year.
Dana, I want to get your sense of what we can expect heading into and out of Friday's jobs report. If the report comes in line with expectations, do we get a euphoric rally? What will the market tell us after that?
Yeah, well, of course, the market wants to see that the employment picture is holding up to a certain extent. But, it also, there's always this bad news is good news hovering over us as it relates to rate cuts. And if there are more cracks in, the job market than the Fed would have expected, or, any of these reports come in a little worse than expected, that could be ironically interpreted well because maybe the Fed lowers rates a little bit faster.
So Dana, what are you advising clients to do right now when they're trying to figure out growth versus value? They're trying to figure out whether or not or how much risk maybe they should have exposure to within their portfolio. What's your advice?
Well, the biggest piece of advice is don't sit in cash markets. We have such an overwhelming trillions and trillions of dollars have flooded into money markets, right? And of course, that's because we finally have some return coming from cash. So it's understandable. But at the same time, if that's money, that's longer term money that should have been in the market or could have been in the market, and your risk tolerance affords that, sticking it in cash, look at what you've missed out on, right? Even on a 60-40 basis. The market has just delivered and delivered, and it really does speak to not trying to time these things and pull out of the market and go to cash. But if you're worried about recession, there's ways to go, right? You can certainly increase your fixed income allocation. You can, within your equities, lean toward more defensive places like quality and low volatility.